Hi, can you hear me?
Good morning.
Hi, Prof. Brad.
Hi, Simpiwe, can you hear me?
Hi, Prof. Can you hear me?
Yeah, I can hear you. Can you hear me?
Hi, Prof. Can you hear me? Hello?
Simpiwe, can you hear me? Can you hear me?
Hello.
Hi.
Hi, this is Wang.
Can
Hi.
you hear me?
Can you hear me? This is Wang.
I can hear you.
Okay.
Okay.
Can you hear me?
Yes. Professor Brodlow?
Yes.
Yeah. Hello. Hello.
Hi, how are you?
I'm the first speaker. Thank you so much for inviting me.
Thanks for coming. Let me see. You can see Magali, which is in the corner of my screen. I don't know if you can see her.
Magali. Hi, Magali.
Hi, how are you?
I can see you. Hi. Now I can see you. Thank you so much for all the organization work.
Yeah, thanks. It was quite challenging getting everybody. Even now, I'm just checking for our commentators. I can see one is already online, and I'm just getting Cyrus online as well. I think he's joining any minute now. So we start on time.
Barry, I can see you, Barry Herman.
Yes, hi.
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 Ms. Martin Edwards, hi.
Good morning.
Hi. Good morning.
So just while we're waiting, as you've probably seen, this has been a bit of an organizational challenge because we have so many different moving parts in all of this. So we've had to be a bit more flexible than we would like. But so that the way we're going to do this session now is Wang has to leave early. So what we'll do is we'll do a very quick welcome. She will present, and then Cyrus Rustomji will comment on her. And then she has to leave, and I think Cyrus will be leaving as well. And then we'll come back and do a proper introduction, and then do the 3 papers and the commentating on the 3 papers, and then hopefully have a very interactive discussion amongst everybody, amongst the audience and the participants. And you should all feel free once we get to that point to comment on each other's papers, because the idea of this is to make it as interactive as possible and to have everybody get as much feedback as possible on their papers. Wang, we are recording this, so if anyone makes comments on your papers, on your paper after you leave, you'll still be able to access that through the recording. And we'll make sure you get the link to that as soon as possible.
That's great. I'm sorry that I have to leave at 9 o'clock because BU has another seminar.
Yeah, it looks like a very interesting one.
I will be the speaker. Thank you. And I promise I can come back after 10:10, which is 17 hour South Africa time.
Exactly. So let's see, I don't think Cyrus is here yet. But I think once Cyrus comes, we can probably start, because I think most people are already in the room. Oh, great. Okay. You're ready to go.
Right. I can stop share. Okay. So I just tested my sharing my screen.
It works well. We could see it.
So you could see my screen, right?
Yes, yes.
Oh, okay, thank you so much.
Cyrus just left. I think he must be having trouble connecting. We'll give him another minute.
I see his iPhone still connected. I see him still connected.
Cyrus, are you there?
He's muted.
Is he? Cyrus, do you just want to indicate you're there for a moment, and then you can go back on mute?
Can you?
Cyrus, iPhone.
Hi, Cyrus.
Hi. I'm not sure if you can hear me.
Yes, we can now. So thanks, Cyrus. We're going to start now. As I was just saying to everyone, we're going to go straight into Wang and Kevin Gallagher's paper and your commentary, because I know both of you need to leave. But we'll do that, and then we'll come back and do more formal welcome after that, but just to accommodate everybody's complicated schedules these days. So I think we're 1 minute into our time. So welcome, everybody. I think my name's Danny Bradlow. I'm a professor at the Center for Human Rights at the University of Pretoria. We'll do a more formal welcome and explanation of the project in a minute. But as I was saying before, this has got a project with many moving parts, and accommodating everybody into this arrangement is not easy. And so what we're going to do is we're going to begin with the paper by Wang and Kevin Gallagher, and will explain the paper in a minute because she needs to leave soon. And then the commentator, Dr. Cyrus Rustomji, will speak then. And when they've done, we'll do a full introduction. I would just want to state, so Dr. Rustomji works for the Independent Evaluation Office at the IMF. And I want to stress independent. So he works for the Independent Evaluation Office and not directly for the IMF. But he's here, and as many of you have heard many IMF people say over the years, and many international organization officials, he's here in his personal capacity, and really not because of his work in the IMF, but because of the work he's done over many years, both as an author and as a government official and an international organizational official on the desk of low-income countries, and particularly the SADC region. So with that, I want to maximize the time we have for substantive discussion. So I'm going to go straight to Yang to begin her presentation, and then we'll go to Cyrus, and then we'll come back later. So Yang, let me hand the floor to you.
Thank you very much, Professor Bradlow, for a kind introduction and for inviting me. Let me begin by saying that I grew up in China. When I was 15 years old, I was sent to the countryside. I saw in my eyes, I experienced the poor living conditions in rural China in the 1970s, and without running water, without electricity. Can you hear me? So I feel very much strongly about Africa's development. Now, our joint paper with Professor Gallagher has 6 sections, but I will focus on the last 3 sections. So first, let me share my screen, and can you see my screen? Okay.
Yes.
Can you see my screen? So we have 6 sections, but I will go very quickly and mostly focusing on the last 3 sections. As you know, the global economy has suffered the biggest shock since World War II due to the pandemic. Global GDP will decline to negative 4.9% in 2020. SADC countries have been growing quite well, but due to the pandemic, the average GDP growth will drop to negative 5.25. Meanwhile, in March and April, there was a large, unprecedented large capital outflows from all EM countries, leading to liquidity crisis. And many countries experienced a loss of foreign exchange reserves and local currency depreciation. As recently the default rates are rising, that crisis is looming. So international cooperation very much urgently needed. So this chart on the left shows the large capital outflows, and it's more severe than any of the previous global financial crises. Now let's go quickly to a little bit literature review. Fisher and Eastley's paper described this debt dynamics. So you can see that in this equation, debt dynamics, the ratio of debt over GDP is determined by 3 factors: the primary deficit, the real interest rate, R, and the growth rate. So if the primary deficit is greater than seniority, if the real interest rate is greater than a growth rate, then the debt to GDP ratio will continue to soar until that crisis happens. Please note, the public asset has never appeared in this equation. There is no distinction on how deficit was created. It's due to government consumption, salaries and wages, pensions, or due to public investment. That's a question mark. Now, there were 3 waves of debt accumulation and 2 waves of debt relief. We think the World Bank IMF's debt sustainability framework needs some revision. And in 2017, it was revised and it was considered by some authors as obsolete because many governments were borrowing at the market interest rate from the private sector. This framework has ignored public sector assets, including infrastructure assets, electricity, water asset, power generation, and power grids, and so forth. So it has an anti-investment bias. The IMF's fiscal austerity program sometimes cut public spending to the bone, which is self-defeating, pointed by Professor Matsukatu. Also, DSF cannot deal with the issue of large capital inflows and outflows in an open and liberalized capital account. So a little bit experience from China. China has never experienced financial crisis in the last 40 years because during each episode of large capital, large crisis, China has expanded monetary and fiscal expenditure policy, so invested massively in infrastructure and avoided capital flight because of their capital controls. So China is only now gradually opening capital account, but in the last 40 years, the capital account was largely closed. Now, let's move on quickly to the sovereign debt issues in SADC countries. I used the traditional method of debt over GDP to measure the debt sustainability in this section. In general, official multilateral creditors and the bilateral creditors are the major creditors for SADC countries. But the amount owed to non-official creditors is decreasing, while the portion owed to bondholders has been increasing, as you can see from the recent debacle with Zambia. So now, what about China's role as a creditor? China has been portrayed as the largest creditor due to the non-transparency of various Chinese lenders' banks. However, according to our analysis, on average, China is the creditor of 17–18% of the external debt for SADC countries, and this represents around 6% of GDP for the 9 SADC countries that are in the DSSI dataset. However, as we explained earlier, the debt over GDP ratio ignores the asset side, and it neglects the sources of debt, whether it's due to government consumption or public investment. So what's the alternative method? Alternative method, I think, is also from the IMF. IMF 2018 publication on managing public wealth highlights the use of public sector balance sheet, including all government-owned and controlled enterprises, financial and non-financial assets. Using this approach, public sector net worth, which equals to asset minus liabilities, is key to debt sustainability and credit worthiness. We could only find 2 countries in their data set. For Tanzania, the public sector net worth was 45% of GDP in 2014. And for South Africa, the net worth was 151% of GDP in 2016. This is only an indication. It's not significant because the number of the difficulties of getting public sector balance sheet. So what's China's role as provider of public asset? As you know, China has been sponsoring and co-sponsoring financing public sector infrastructure. And I looked at data from ChinaAidData.org. There was thousands of Chinese sponsored projects. Justin E. Fulin and I, in an earlier paper, have identified 214 completed infrastructure projects, including water and electricity and transport and communication projects. So among these 214 completed projects, 78% of them has helped address Africa's bottlenecks. So what are the bottlenecks? We used 8 indicators to identify bottlenecks or binding constraints in African countries. This is for 54 African countries. And then we try to match the probability of hitting these bottlenecks in each country. So we found that 78% of completed projects have addressed these bottlenecks. So we really strongly support the approach of using public sector balance sheet because it incorporates public asset and liabilities. In addition, SADC countries have good level of produced capital, human capital, and natural capital. The natural capital includes subsoil, minerals, and land and forest. These countries can be divided into labor abundant and natural capital abundant countries with distinct comparative advantages. And there is a huge potential they can export to the rest of the world. So Section 5 looked at the Chinese actors' behavior. We found that the Chinese state actors are holders of patient capital. In an earlier paper with Justin Lin, we defined what is patient capital. Patient capital includes those ultra long-term capital invested in a relationship. It's equity-like capital invested in developing countries. It's similar to venture capital investing in promising ideas. So according to the other studies, Aker, Deborah Boatigan, they have searched many Chinese loans and no asset seizure is found and no evidence is found to support the so-called debt trap diplomacy. So we looked at Chinese banks' behaviors and they were quite flexible and they show a degree of forbearance during the debt crisis. So you can see from this chart this is provided by Kress et al. In Rhodium group. And in the earlier years, there were some write-offs. The write-offs are indicated by deep blue bar, black bar. And for each of the FOCAC summit, and the Chinese government has forgiven some of the debt. Government zero interest debt. However, in the recent years after 2010, and there are very few write-offs, but rescheduling is possible, and refinancing are more possible. Conclusion: what more can be done in addition to the debt service moratorium? We discussed five policy options. First, I hope all governments can support multilateralism and pushing for the IMF to allocate more SDRs, as issuing and redistributing SDR is unconditional and counter-cyclical. Second, support MDBs and regional finance arrangements for more emergency loans. Third, this is our proposal based on already completed projects which are part of the public asset. MDBs can design and explore innovative methods, including asset-based refinance. I can elaborate later. Now, fourth, for Chinese, they prefer tailored options. We have in many occasions suggested the government to adapt and to enact a foreign aid law to promote transparency. However, it has been very slow, but the Chinese leaders have a preference for tailored solutions rather than blanket forgiveness. So far, China has been acting within the common framework agreed by G20. recently, Zambia got a debt relief of $110 million. China's debt restructuring is also driven by requests of the host countries. So for example, Hambantota port in Sri Lanka, which is requested by the government to be built. And then later, the government also requested China to find a private port operator to operate. So it's a build, operate, and transfer deal. It's a PPPI approach. So the UK's Chatham House, they have investigated this case, and no asset seizure is found. And for Chinese creditors, demonstrated willingness to repay is important. Okay, one of the examples is Pakistan recently got a new loan of 1.3 billion after repaying an old loan. The fifth option is debt for climate swap. I'm not an expert. Our co-author, Kevin Gallagher, is an expert. So there is now over 30 years of experience on debt for nature swaps. One of the examples is Seychelles. An economist group 2020 explored this case. Last but not least, for SADC countries, it is important to know what your government owns, meaning asset, and what your government owes, liability, and to enhance the government's capacity for asset management. And also important to distinguish patient capital from multilateral and bilateral agencies from with those footloose capital. And the government should utilize patient capital for structural issues such as capacity for production, for export, job creation, and export competitiveness. So only in this way we can get rid of the reliance on that. Thank you, and your comments are highly appreciated. I look forward.
Thank you, Yan.
to your comments.
Thank you very much. You've given us lots to talk about, but I'm going to go straight to Cyrus so we can maximize the time that both of you are available. Cyrus, let me hand over to you. You're on mute at the moment.
Is that better? That's great. Thank you very much for the opportunity, Professor Bradlow and colleagues, to comment on this paper. And more broadly, just to be involved in an experience of this kind. It's frankly wonderful to have new innovations, new ways of looking at what are sometimes perennial challenges, which sometimes don't find an adequate solution. Myself, I've been working on developing countries, low-income countries, African countries, small countries for a number of years. And often challenges come and go in cycles, and often very little comes along to break the cycle that seems to perpetuate the challenges. Debt is a perennial challenge, and as the paper shows, there have been a number of cycles of debt relief followed by debt distress. Nothing in the on the horizon seems to suggest that these cycles are going to be fundamentally broken, absent new innovations, new thinking. And I think the paper makes a good effort to try to design an architecture that can take that, turn the cycle into something less vicious in its perenniality. So I certainly welcome the paper. I think it's got a lot of very good ideas. I have a few suggestions about how to maybe tweak some of the ideas in the paper, and also to dig deeper in specific areas. I have a few general comments and then some specific ones on the paper itself. So one general comment, in a sense, is that this, if anything, if traction comes from the ideas contained in the paper, in my view, it will be a long-term endeavor. I don't think it will suddenly break what is really a whole architecture designed around debt sustainability, its computation, and the impacts on how creditors perceive debt challenges. So I think this is the start of a very, very long haul. And it's for that reason that I mentioned a few specific suggestions in the detail to try to make that journey maybe a little bit shorter. The second issue is that with the presence of COVID, and certainly from the vantage point of the work that I've been either doing or seeing in the context of an independent evaluation office, COVID is changing quite fundamentally the outlook for many, many countries. There's some suggestion in the paper that COVID impacts are significant, but not as damaging as elsewhere. I'd suggest taking a closer look at that, because I think there are structural factors that will arise as a consequence of COVID, which in the SADC region may be more substantial than initially meets the eye. Certainly all countries are suffering declining revenue and very substantial increase in expenditure to try to cope with the impacts of COVID, loss of growth, loss of export markets, certainly loss of employment, at least in the short and medium term. So I think the COVID incidence of COVID is going to change the equation, and I suspect it'll run through much of what's in the paper. It needs to be re-looked at in some sense in the context of a post-COVID environment and the damage that the pandemic has caused in the context of the opportunities that are there for re-looking at debt sustainability. Then maybe looking now at some specific issues. Just starting with COVID, I think it would be valuable if we are going to, if you deal with COVID in the paper, to have a little bit more treatment on the impacts on one or two countries, just to illustrate precisely how this can translate into the implications that are contained in the paper for better ways of dealing with sovereign debt and raising resources based on infrastructure assets of countries, as suggested in the paper. The second is point is about the aspect deals with the coverage of debt in the paper, debt GDP presentation there. And again, I'd suggest, although it's a SADC-wide paper, it would be good to look at specific contexts, because I think aggregating debt GDP over 9 countries often diminishes significantly the nuances, takes away the opportunity to look and see what the implications of a new overarching structure is being proposed for gauging debt sustainability. It diminishes that. So perhaps in the paper, if there are 1 or 2 areas where there's 1 or 2 case studies or something on the debt GDP trajectory, that would be useful. And if that is going to be taken up, then also to disaggregate a little bit by the types of economy, because otherwise when we delve into debt issues, we don't make distinctions between commodity-driven economies or those that are particularly undiversified. It tells less of a story about how to unwind debt positions. And certainly in SADC, experiences differ widely across SADC members, so it would be important there. There's a reference to the debt GDP ratio and the target for SADC of 60%. This is common among other country groupings internationally, and they have had experience in how they've calibrated over the long term their debt trajectory using 60% of debt GDP as a ratio. So it would be useful maybe to reference some of this. And in my recent work, I guess in the last couple of years, Caribbean countries have also adopted, or a group of Caribbean countries in the ECCU, Eastern Caribbean Currency Union, have adopted the 60% debt GDP ratio. And they've had very interesting experiences in how they've managed their debt through that. So maybe some references there. Another aspect in section 2 of the paper on debt GDP that I think will be important to gain, to put the later part of the paper on a more solid footing, is to deal a little bit more with the changing composition of debt in SADC countries and more generally in sub-Saharan African countries. There's been a lot of very, very good work done by the African Development Bank in this area, both 4 or 5 years ago and also more recently. And I'd suggest making some reference to some of that. There are also some authors, international authors, that Machido Nisanke at SOAS, who's done work in this area and also critiqued the debt sustainability framework. And I think tying her work into the early part of this paper or making some reference to that would be probably quite useful, and may also shed light on some other angles into the critique of the debt sustainability approach as well. ODI in the UK also has done work on debt challenges in African countries and has used case studies, I believe, of a number of SADC countries. I think that's a couple of years old, but not much more than that. And that, again, could be useful. Then also, if there's going to be a critique of the debt sustainability framework, as in the fund's debt sustainability framework, I think it'd be important to make reference to developments in the fund, in the IMF, in the last year. In the last year, there have been reviews, and I'm pretty sure that they've been published by the board of the debt sustainability framework. And you may or may not know that in the fund debt sustainability framework, there's a framework, which is the methodology, and then there are assessments which are done for individual countries. These are called debt sustainability assessments. And there are 2 types of assessments. One is for low-income countries, and one is for what they call market access countries. In both cases, there's a history and an institutional fabric to the assessment frameworks, which has been covered, which has been reviewed. And in the last year, both of these have been substantially reviewed, upgraded, improved, in my view, and go much more deeply into the nuances of debt sustainability. Acknowledge debt sustainability based on a debt GDP approach as critiqued by the paper, but nevertheless the reviews have taken place. It would be important for the paper to take cognizance of them. There have also been 1 or 2 things that have happened just recently with the G20, with the debt service sustainability initiative. I forget what the other S stands for, and particularly with the recent G20 meeting, not even 2 weeks ago, where it appears that China has signed on to the approach that the fund is using. So that itself may need to recalibrate the orientation a little bit of the paper, because the paper is in some sense juxtaposing the broad creditor community and China, whereas China seems to have adopted some of the principles that the rest of the G20 are adopting in the context of debt sustainability in developing countries. On the section on China in the paper, the figure 3.1, I should say, I think it may be slightly outdated. I think it'd be important to just check that information is updated there on Chinese lending to SADC countries. I may also mention that there is some very detailed work on the creditor profile of China in developing countries, which was produced by Rogoff and Reinhardt. They often author papers together, but they dissect Chinese lending in the context of sovereign debt in considerable detail. I can't remember what the name of the paper is. I will go and look for it, or go and look and see where I saw it, but it's very, very detailed work. It's the first time I've seen it with that level of detail. I don't even recall what the specific outcomes were, but I can imagine that having a read of that paper may inform parts of this paper. Figure 3.2, I think it's important when we're looking at SADC debt, external debt, and debt GDP ratios to go back further than 2014. The reason for this is that it would tie in much better with the last cycle of debt relief, which was pretty much from 2000, and signal in some sense that SADC and many other countries are kind of coming full circle with their debt trajectories. One of my jobs 20 years ago was representing African countries on the IMF board, where we were fighting for HIPC debt relief at the time. And they were suffering from very severe unsustainable debt. Now the cycles kind of come back, but the structural problems that are driving the challenges from an exit from unsustainable debt are all that much more severe. But nevertheless, I think looking back a bit further will tell a better story for the paper. Section 4, I think this is a very interesting area of work, trying to present a new approach to thinking about debt sustainability. Like I said at the very beginning, I think it's a long-term exercise. The critical issue really is to an alternate approach to measuring debt sustainability and to working out the implications of that practice in terms of accumulating further debt. That's a long-term goal, a long-term approach. I don't think it's going to come very quickly. And I think the analytical work, as this paper starts to do, needs to be developed. There are critical issues that I think the paper needs to think about in taking this forward. And one is by clearly mentioned on page 14, which is that if all SADC countries could essentially develop the data for this. Now that's a big if. Developing the data that can effectively quantify public assets and particularly infrastructure is not an easy task, at least certainly to get it to a degree of reliability that can persuade creditors to consider lending on that basis. So thinking about how that task can be achieved, what SADC would need to do, is something that I think it's important for the paper to comment on. There are other, if I can say, handles that that I think it would be important to think about, if not in this paper, then maybe in a subsequent version or further updates. Try to link this idea to something tangible for SADC. So, for example, the SDGs. The SDGs have an enormous infrastructure component. They require infrastructure. Of course, this will be new capital, but try to quantify, I'm just thinking aloud, but try to quantify how, if we had had an SDG framework, that infrastructure could have been financed using this approach. And think then more dynamically about how will the SADC infrastructure for the SDGs be financed if this approach were used. There is some work I recall now, but again, I can't give you a paper, but it's almost maybe 7 years or so ago. I think it was by a Canadian economist, Culpepper, but again, I'm not quite sure. And the reason I'm raising this is because in the transition from the MDGs to the SDGs, there was a very strong set of discussions about how the infrastructure needs for sustainable development would be financed. And it came to a discussion about debt dynamics. And I think it was, and the future challenges for debt accumulation in the context of such large infrastructure requirements. And I think it was a Canadian author that shed some light on this. So it may be good to look at that. The other author to look at strikes me is also Bhattacharya, Amar Bhattacharya and Homi Karas. Both of these, they're both at Brookings. They've written in a lot about how to finance infrastructure in the SDG context. Bhattacharya has quantified this in the context of developing countries, and I think at a disaggregated country level as well. So it might be good for the SADC paper. And then finally, on section 4, this concept of patient capital. I think this is a very nice handle into developing further the concept of a public sector net worth basis for debt sustainability. Here, there's a lot of work that has been done, and I think ODI and Dirk Willem te Veld at ODI in the UK may offer some further insights through those publications. So final set of comments, Danny, and I hope I haven't been too long. Forgive me if I'm droning on too long, but and then I won't have much more to say. So the final section is the most appealing to me in this paper, and it's because I think it provides the keys to unlocking the analytical, theoretical, and insights that are contained in the paper. So I think the array of ideas, I like all 5 of the ideas for a more dynamic way of generating resources for SADC's development. I also want to suggest the paper looks at some innovative practices that have occurred elsewhere, which in some sense add to the list, but they also deepen in some areas the issue of debt swaps for climate and so on. So the one is the experience of small countries, because very small countries, islands, and including African islands, so we're talking about the Seychelles and Mauritius, they often shed light on the most innovative debt-related solutions. So the Seychelles is an excellent example, but there are others as well. And I think it'd be good for the authors to go to the architects of those financial instruments themselves. What they've done, stepping back from the architecture of the instrument itself, and which is important for SADC, is that they have removed the discourse about where to receive new sources of debt. They've moved it away from a terrestrial focus to a maritime focus. They've moved it to, there's an enormous, in the language of the paper of Gallagher and Wang's paper, there are assets in the ocean, and we can tease out the value of these assets in the ocean through marine protected areas, through quantifying the value of those assets, and then locking in the resources that are needed to manage in the case of marine protected areas, and also exploit in the case of the economic wealth that is in the maritime zone, these resources. Seychelles, Mauritius, Barbados, Grenada, these are examples. I should also say India, Bangladesh, some Southeast Asian countries. These are examples where they have innovated, and they precisely fall in that last section, the concepts of the last section. They've also innovated in debt contracts with hurricane clauses. These countries are susceptible to natural disasters, as are SADC countries, and they are succeeding in embedding hurricane clauses in debt contracts. So when hurricanes hit, they get a payout for that. I think that's all, and be happy to chat more. It's just that there's so much going on. But I welcome the paper. I think it's a wonderful initiative, and I wish the authors every success in developing it. Thanks.
Thanks very much, Cyrus. That's great. That's extremely detailed comment, and I'm sure the authors will appreciate that. Jan seems to have dropped off, so I'm not going to give her an opportunity to respond at this point. I know you also might need to leave. You're welcome to stay as long as you possibly can, but we understand if you disappear as well. You've set a very high bar for commentators going forward, but thank you for that. I think given the time, I'm not going to go into the background of the project as I would have done at the moment. I think what we should do is maximize our time for the papers and the commentators. And so I think let's go straight to the next set of papers, and then at the end, I can talk a bit more about the project. But I think we're in for too rich a discussion to do that. And we have 3 papers left. We'll do all 3 paper presentations and then have commentary afterwards. One of our commentators seems to have gone, is not here at the moment. So I know he's read the papers, but hopefully he'll be able to join us at some point. But let's start. We'll go in the order in the program. So we'll start with Martin Edwards, then Barry Herman, and then Amitabh Mehta, and then we'll come back for comment. So Martin, let me hand over to you to present now. The only thing I should add is I have some bandwidth problems. So if I switch off my video, that's not because I'm disappearing. It's just that I'm trying to preserve bandwidth and remain connected. So please excuse me. But Martin, you're on mute at the moment.
Yep. Okay. All right. I hope that's better. Okay. Very good. Wow. Everyone set a really high bar this morning. Professor Wang, that was a great paper. Cyrus, those were great comments. And we'll see if I can measure up. I'm not doing PowerPoints. It just seemed to me with 10 minutes, everyone's sort of pedagogically exhausted with PowerPoints. Thanks to the organizers and thanks to the other panelists, Professor Bradlow, Magali, thank you so much. I had two graduate assistants help me with this project. So it was incredibly important right now for me to use my time effectively. So I'm very grateful to Fred, Sean, and Zara Auerbawi for their help in this. So let me get to the bottom line. The question I ask in the paper is this. We know, and Professor Wang really sort of laid this out, that the pandemic is making developing country finances less sustainable. Okay, that's a given. So the question I pose in the paper is this. I'm a scholar of the IMF, and a lot of my work as of late is focused on IMF surveillance, which is a little understudied relative to lending. So my question is this. Did the IMF warn countries prior to the pandemic that they were increasingly indebted, and so their economies were becoming increasingly fragile? My answer is this: yes, but when we look under the hood at sort of a subset of SADC countries, we'll actually see ways that the IMF surveillance practice can be improved for us moving forward. So briefly, surveillance is obviously a critical role for the IMF. This is, part of its mandate to ensure stability is that it looks at economies on an annual basis. This is sort of underpinned through Article 4 of the Articles of Agreement. So this is referred to as Article 4 reports or Article 4 processes. And we know this is what international institutions ought to do, is reveal information, provide greater transparency. But we also know that the effectiveness of that surveillance is moderated factors that are both internal to the fund and external to it. Externally, the fund always has this challenge of speaking truth to power and making sure that major powers are sort of reined in as much as developing countries. Internally to the fund, it faces time constraints. In some years, it's faced budget constraints, which have hampered the quality of its surveillance. And of course, it has a standard economic model that it applies to the world, which sometimes doesn't quite fit. After the global economic crisis, the last one, right? The criticism of IMF surveillance focused on the lack of early warning, that had it connected the dots about fragilities in between the US housing market and the banking sector, we would have been much better off. Okay, so that was a key point of criticism. And that's kind of the starting point for what I'm trying to do. So what I do in the paper is the following, is I focus on sort of a most likely group of countries. So I focus on 6 SADC countries with a significant increase in external debt service since 2010. Okay. And if there's any place where we should see warnings, it's with these countries. So these are Angola, Malawi, South Africa, Tanzania, Zambia, Zimbabwe. And what I do is look at the most recent Article 4 report for each country. Okay, so these are large documents. They're freely available on the fund website. And they're obviously very technical. This is written by IMF staff, and they obviously are experts in their field. So that's the question. Was there warning in these 6 countries? Now, quite obviously, there are some limitations to what I'm about to talk about, right? I'm not offering any judgment on the quality of the fund's advice, so I will sort of save that for another time and place. And also, we only see the final product of these discussions. So what's released is a press release that summarizes the executive board discussions and the staff report, which is the document that's brought to the board that's written by the staff as it visits each member country. So findings are in the paper, but of those 6 cases, I find that there are sort of clear warnings in 5 of the 6 of them. Okay, so that's obviously good. But discussions of foreign debt are not always a top line item in that press release. That only happens in 2 of the 6 countries. Okay? In a sense, that's concerning because these 2 documents represent kind of 2 different processes. The press release is a distillation of the fund executive board discussion. The staff report is, of course, the document that's brought to the board. And so divergence between those kind of raises the question, is a warning signal being sent as strongly as it ought to be? If one looks under the hood at the staff report, though, there is, as Cyrus rightly pointed out, there's plenty of high quality evidence, and it's gotten much more detailed and more analytic in recent years. Plenty of evidence under the hood on warnings. So these reports now have a debt sustainability assessment. They now have a detailed assessment of country risks. And so in a very real sense, one has to dig a little bit to sort of see evidence of warning, but it is definitely there in 5 of those 6 countries. Let's see. It also, in terms of findings, there's also one case. So I mentioned 5 of the 6 countries. There's one case of outright transparency avoidance, which is Tanzania, which last year chose not to release that press release and chose not to release the staff report. Those are country documents. But importantly, that was kind of a clear departure from regional norms and global norms. Since this process of making these reports more transparent was rolled out, this has become almost an unquestioned thing. I said, this is what countries do. They release these reports. So that was sort of an aberration, so there was a clear case where Tanzania said, it's like, well, we don't, we're going to not reveal what's going on in these discussions. But importantly, there's no evidence that any of the more subsequent discussions in the SADC countries were affected by this. So this is sort of a one-off, and that's obviously really important for us. If we want to make sure this norm of transparency sort of remains robust. Otherwise, obviously, we have bigger problems with the global financial safety net than we would originally think. So for us more broadly, I guess the takeaway would be this, in a very real sense that we want to think about the viability of the global financial safety net. And so in one sense, the surveillance piece actually does work. And so this is a notable thing. But obviously, we're not out of the woods. Much of the fund's surveillance activities have been scaled back in recent months because it's devoted more of its staff time to lending, which obviously makes sense. And as we go forward, there is a comprehensive surveillance review that's in the works. but one of the lessons for us for that is that we can still focus on sharpening our messages to make sure that that the fund sends clear signals when it needs to, and there's no divergence in messaging between the staff and the executive board. So I was given 10 minutes, and that's 10 minutes. So thank you very much. And I look forward to your comments.
Thank you, Martin. You were right on the button. What we're going to do is go to Barry now, and we'll come back to the comments afterwards. So Barry, over to you.
Okay, let me get myself unmuted and share my screen. Let's see. Didn't work. Oh no. Okay, hold on a second. I got to start my slideshow. Why doesn't it start? Here we go. Okay. All right. Can you see it?
We can see it.
I hear nothing from it. Yeah, good. Okay, so I'm focusing on the pandemic and the debt problems caused by the pandemic and the what to do about it. This is actually the second global crisis in 10 years, and it's not going to be the last. So, okay, my screen just shows my my own slideshow. Can you still hear me?
Yes, we can.
We can hear you.
Oh yeah, okay, good. All right, so what's today's problem in a nutshell? Spending is up to fight the coronavirus by governments. Spending is up to partly compensate for the loss of livelihoods in most countries. Tax revenues are down from reduced economic activity. There's little additional international grant support. That is to say, and I'll show you some figures about official development assistance, bilateral official development assistance, which is mainly grants, which has not been growing. So what's the outcome? It's an inevitable surge in fiscal deficits, and you cover the deficit with some mixture of credits or debt relief. Just arithmetic. I want to show you the difference it makes, the different qualities or quantities of access to finance to external credit or credit makes for government. You can see that for the advanced economies, a tremendous increase in their deficits as a share of GDP. It's more than 4 times higher this year than last year. You can see in the emerging economies also a significant increase, about doubled. But you see only 50% increase in the low-income countries who have less access to credit. This doesn't mean problems in the low-income countries were lower. It just means they had access to less credit. Okay, now where do you get the credit? Well, these days, the primary source, or at least I won't say primary, but the source that has been advocated as the future is private money, especially bonds and credit, bank credit. And in the left panel on this diagram, you can see that for the frontier economies, which are basically low income, lower middle income countries, it's not just Africa. The right panel shows you that they are distributed across all the regions, and the countries have been increasing their reliance on bonds in particular for financing government. Okay, look at the Africa on the right. You can see 2019, the yield or the interest rate that bondholders would get for buying a newly issued bond for the average of the frontier African economies was about 6% annual yield. That is to say, the gray line is the spread over U.S. Treasuries, 10-year U.S. Treasuries. It's about 1 or 2%. So it looks like 6, 7, 8% annual yield on bonds issued by frontier African economies. Comes the crisis, prices of bonds drop, and that means that the yield from the fixed interest coupons on the bonds becomes much larger. If you're now holding a bond whose price has dropped and the interest payment is the same, the yield is much higher. And what this shows is that if African countries, frontier African countries, sought to issue a new bond, the spread would have been approximately 15 percentage points. That's 1,500 basis points. Basis point is a hundredth of a percentage point interest. So it would have been 15 percentage points, 15 spread, so 16, 17% annual yield. That is prohibitive. Now it's come down. And in fact, in the first paper, there's an indication of what's happened in the financial markets up through, I think, probably March or April. But things have improved, the markets have come down. But the African frontier markets would still have to offer creditors interest payments of about 12% or more a year if they wanted to float a bond. Well, guess what? No bonds. African countries are not, and frontier market. I don't know if frontier markets as a whole, but for sure, from what I understand, there hasn't been an issue, a new issue of South Africa of frontier market bonds. Okay, so forget the private sector. What's coming from the public sector? Well, as I already indicated, this is monthly commitments of official development assistance on the left by bilateral donors. It shows that in the darker color for 2020, month by month, there is basically less aid being committed than was in 2019. Look then at the right, multilateral donors, International Monetary Fund, the World Bank, etc. And you see a huge surge. This is good. It provides liquidity, but these are not grants. These are loans. And this is a longer time series, and it takes us through July. It's the data for January to July of what are called aid, but it's not only official development assistance. And you see the credits have been rising, and therefore the debt burdens have been surging. So what has the international community offered as assistance? The IMF has been issuing loans with low conditionality. They're quick dispersing. You get it in one bunch of money, and they have issued quite a bit of that. The World Bank has been issuing new loans. In the paper, I talk about the loans from the Islamic Development Bank, from the African Development Bank, and so on. They're all credit. The IMF also has a unique system for giving debt relief to low-income countries impacted by the catastrophe. And it has approved assistance now for 28 countries through next April. And what happens is that fund, that Catastrophe Containment and Relief Trust, pays the interest and principal due from these countries to the IMF. So it is real relief. The countries are freed of pain, and it's funded by donations to this ERT. In addition, the Group of 20 has offered a moratorium, and it is essentially a refinancing of interest and principal. It is now on offer through next June. And although 73 countries were eligible, only 42 took the offer. I may be a little out of date. It may be 43 now. I'm not sure. Why did they not take the offer? Well, it's not that great an offer. It delays your payments, but it only delays them, and it adds interest on the delayed payments, number one. And number two, there is a fear that the private sector lenders would be nervous and be reluctant to lend more. I already said, in that sense, it's kind of ridiculous because they're not lending anyway. But in any way, the other thing is that the Group of 20 just last week offered this common framework for debt restructuring. The major news in that is that China has agreed to engage in a Paris Club type of mechanism. There's little promise of debt reduction, and there's little buy-in expected from private creditors, and there's no provision for multilateral. Okay, so that's what we've had, and that is not the way you should address financing catastrophes. So what should have been done should be a substantial increase in grant resources. As I showed you, bilateral official development assistance has been stagnant. There is a mechanism at the International Monetary Fund, the special drawing rights, which are very interesting assets. We can talk more about them. If not for the opposition of the current United States administration, there would have been a new allocation of SDRs. The last allocation was during the financial crisis. So that would be one way to help reduce the need for borrowing. And I also think there should be, written about this in some facilities like the CCRT at the World Bank and the regional development banks that could be set up, and they could be funded by SDRs that are actually sitting already idle, unused, and will never be used by the advanced economies. They could be used. And finally, I wanted to note that the IMF board might, in its provision of credit, in its decisions to provide credit to developing countries, especially those in this situation impacted by the coronavirus, might indicate in their in the summary of their meeting that the private creditor should reprofile, at least reprofile, if not, say the country is insolvent and needs to reduce its debt. There is a model for this, not by the executive board, but by the staff. IMF staff did 2 technical reports on Argentina, which basically said to the creditor community, this country is insolvent and needs a debt reduction. And that's a powerful signal. It's not a legal requirement, but it's a powerful signal. Longer term, I would like to suggest more use of different kinds of loan, of credit. And the first type is actually available already. It's quite used, the sukuk in Islamic finance. And the second is, as I call it here, non-recourse social revenue bonds or environmental revenue. Let me just talk about the revenue bonds. There are bonds that in which they're for a project, and the earnings of the project provide the resources to pay the debt servicing on the bonds. For example, if the money is to fund a turnpike or housing, public housing, these projects should earn revenue, and the revenue should be, some part of the revenue could be devoted to the debt service. Now, social revenue bonds would be bonds which are dedicated to social projects. And non-recourse means that if the project runs into trouble, the government, general resources of the government cannot be tapped for repayment. I think these could be more widely used. Social bonds are becoming more familiar in the market. The European Union has just, is pledged to put out 100 billion euros worth to use for recovery within the European Union, in Italy and other places. Okay, but it's a niche. Basically, governments do need general obligation bonds, which are paid out of the general tax revenue. And there are these state contingent clauses, which is already mentioned, as in Barbados, in which if there is a hurricane, and if it is certified by an independent authority, which is specified in the bond, then the debt servicing for the period of the crisis is delayed, and it so provides liquidity. The French government, the French aid agency, has also got a loan. I never remember the name of it. It's the Trade Concessionnel Contracyclique, and it's for a number of African countries, and it's a version of another loan that the Agence Française de Développement offers. That loan is a 30-year maturity with a 10-year grace period. This loan has a 5-year maturity, 5-year grace period, 25-year maturity, but the borrower is able to take 5 years of payments and delay them at its on its own choice, on its own decision. But there has to be some qualifying event, like a fall in export earnings. So these exist, and the question is, every crisis is not a hurricane. Barbados sought assistance, coronavirus assistance. Prime Minister was told, sorry, no, you're an upper income developing country, you don't qualify. Nobody said they didn't qualify for a hurricane clause. I mean, a crisis is a crisis. And so it would seem to me what you need is something that is not so specific as hurricane clauses or the way the French loan works. And two law professors, Wiedemeyer and Mitogolati, put out a paper recently on the concept of necessity, and that it's questionable whether necessity will be recognized by the courts as a reason for not making payments. But I'm proposing that it be explicitly included in bond contracts and in bank loans and so on, which would not specify what the trigger is, but would specify a process by which delay in payments could be made. Further thing is that the World Bank did not give any debt relief, and it says, no, we can't. We are afraid that should we give relief, even to our poorest countries, the people who and institutions that buy World Bank bonds would say, oh my God, the World Bank gives debt relief to the poorest, maybe it'll give it to the less poor, and maybe they won't be able to pay the debt servicing on the World Bank bonds. You know, the way the World Bank and the other development banks work is they issue bonds and then they lend the money out at an interest rate somewhat above the bonds, which covers their cost of operations. They are, in this sense, this is a financial intermediary function. So, in fact, the equity holders of the World Bank and the other banks have the equity already in the bank is plenty, and the equity holders could pledge that they would make good on any losses as part of the decision to give debt, to set up a debt relief mechanism. Last slide. I think we have to distinguish catastrophe relief from debt reductions that will return the country to debt sustainability. I would suggest that the IMF establish a policy in which first there's a relevant technical authority like the WHO for pandemics, which declare a catastrophe has occurred. And if the IMF board expects that a sufficient negative balance of payments impact from that catastrophe will impact one or more countries or the whole world, it would trigger a moratorium on all medium and long-term external sovereign debt service of the affected countries. What we have now is an IMF policy in which pandemic is declared, and the executive boards agrees to lend money on a very quick basis. They have these they call them rapid facilities. So the difference between what I'm suggesting and what they're already doing is that it should trigger debt relief, a moratorium. I would include their bilateral official debt, which is what's now offered by the G20, market financing debt, multilateral debt, although I would prefer doing that with a CCRT-like mechanism. Finally, return to debt sustainability. That's a more general problem than the recovery from catastrophes. Not all countries will be insolvent. All of them should be assisted, but not all will be rendered insolvent. And there is a process. I would say it's far from perfect. There are many reform ideas. There are no consensus on what should be done. But I think this is now time to begin discussing in the international community how to go about a more comprehensive, fair, intergovernmental process for debt workout. There is, in fact, a mandate if the UN wants to pick it up. And there's a process, there's a committee, there's a financing for development follow-up forum, which the General Assembly said if we ever want to talk about debt workouts, we should talk about it there. It is a body of the Economic and Social Council. It is a political forum. It could establish principles. There are various principles. There's a set of UN principles, but they were voted, and the developed countries did not vote for them. So, forget it. That's useless. There's no consensus. But they could work towards some process. I think it would have IMF in the middle. But in any case, it's beyond. That's a story for another day. What I wanted to focus on is a more effective system of financing and relief to deal with catastrophe. Thank you. Okay. Okay.
Thanks very much, Barry.
Okay.
That was great. Lots of food for thought and discussion. But let me hand over now to Amitabh Mehta for the third paper. Amitabh, there you are.
I am here, Daniel, and I hope you can hear me.
And we can hear you well.
Excellent. Let me share. And there we go. So I did put together a presentation, which is probably a good idea, but I'm not sure how well it works on Zoom. Let me just start first by saying, Daniel, that I think that this initiative is a fantastic idea. When Magali originally approached me, I wasn't too sure, in fact, but I actually think that, one, it's extremely important that people come together on the topic of COVID and post-recovery COVID. I'm spending my days doing only that. What's exciting about this part is, though, that the different papers that I've had a chance to review, pretty much everyone today and I think a couple later, interestingly have come from different angles to probably the same kind of area, different sort of approaches, but to a similar kind of long-term approach, as it were. And I like that because, you know, you've got the IMF side, we need early warning signals so that we can do something about future problems. How do we fix it today? Barry just now spoke fantastically, and his paper is my favorite out of a lot because it speaks very much to a practical approach to doing things as well. And I, from my side, wanted to bring a much more of that practical side into my paper as well. From what's going on around the world, because this is already happening. Places like Southeast Asia, South America, and so forth are all looking at this right now, because this is not just a problem for Sadiq, this is a problem globally. And of course, there are a lot of similarities that one can, and ideas that one can use over here as well. So I won't go too much into the debt management challenges. I think everyone's pretty much covered it. The problems are continuing, commodity prices are falling. The other side that I work a lot on catastrophe bonds and catastrophe insurance and things like that. And of course, the area has suffered quite substantially pre-COVID from El Nino and droughts. I've also been lucky enough to be working on the African vaccine manufacturing, local manufacturing initiative for quite a few years. So I'm very well aware that healthcare, of course, is also an important part of that. And all of these, of course, are lending towards the increased spending requirements within the region, certainly. I think COVID, of course, without question, has made everything much worse around the world, but particularly in this part of the world. I'll pick on a couple of things. For example, you've got the FDIs really disappearing very quickly, and that's not just because of the region and its problems, but also because globally capital markets, etc., are just stopped. All the very, very simple, non-dangerous kind of investments that they've made have suddenly gone to bust. Securitizations, so forth. Everything is on its way down. And so suddenly no one's investing. So that's a big, big, big problem as well. The one thing that I guess I would love to mention also is the informal sector, because within SADC, it's specifically an important part to play within the debt issue, because I think the informal sector, because it's such a big part of the overall GDP of the actual region, must be also looked at. I don't think there's any real numbers around how badly it's been affected, but I think that that's something that's made much worse by the COVID situation as well. On the other side, of course, it also brings opportunities. Barry spoke just now about a variety of different kinds of bonds that are being issued around the world. There's a different awareness in the market. Suddenly, COVID has brought awareness to the market in terms of social impact initiatives. And along with that, social impact financing. So impact investors are growing. Over the last 9 months, if you look at the capital markets globally, they have been quiet, right? In fact, a negative, I would say, in many cases. No new issuances, no IPOs, nothing. Suddenly, one asset class is growing, and growing like mad. And those are COVID bonds. And as again, Barry mentioned, I think a couple of minutes back, in Europe, the 100 billion one that the European Union has been discussing for, well, since March, the Corona bond, as it's wonderfully called, that is something that is grading. Yeah. So sustainability bonds, Corona bonds, all of these bonds are really growing very fast this year, and there are investors for it. It's not just being issued by multilaterals and by governments, but also by the private sector. Bank of America was one of the first ones, BBVA, etc. So there is a new asset class in terms of the capital markets that is growing, specifically that could be very useful for a region like SADC. Trends are changing, right? For example, tourism and so forth, when it comes back, and it will, it's still going to be very much a new kind of a style. Working from home, very much so. Working in remote places, very much so. Also, because of the losses that are being incurred right now by a variety of companies across the world, airlines or whatever business, all of those guys need to reduce costs. So they need to move to places where they can actually reduce costs going forward. So I think that SADC, if it plays its cards right, could actually attract a lot of that money. If it plays its cards right, even the beginning of this presentation, I've put something about a sustainable recovery, about a green recovery, about an SDG recovery, which also one of the other speakers spoke about. Why? Because that's where the money is at the moment, and that's where the money can be attracted from for doing things and helping the debt situation in the region as well. So as I've said, I mean, the key to this is not just a one-off. We're not trying to fix a debt problem or a debt crisis that might happen. This has to be a sustainable, long-term thing. And many of the components that the other speakers have spoken about and have written about as well, all have to come together. It's a long-term good dish which needs different ingredients within that. So all of these things will have to come together to create not just a fix, but a sustainable fix over a longer period of time. And that requires a holistic approach. And that really requires a sustained economy, right? At the end of the day, debt, GDP ratios, for example, and so forth, those are all a subject of how the economies are going to be successfully functioning over years, right? The US, everyone knows, has had a very high ratio for this side, for example, over 100, right? 110, 100, whatever, 15, depending on which numbers you look at, but they still function because the capability of repaying it is okay. So the 77% on its own, or the 50% ratio for the SADC region, heading towards 77, is not that important as is important the capability. And that's what we're focusing on. And capability depends on the capability of the economy to be providing, to be functioning, to be moving. And for that, infrastructure is without doubt one of the most important growth drivers. So whatever way we look at it, I think that is something that needs to be focused on if you want to fix the GDP, the debt problem, as it were, or the expected debt problem that's going to come in the future. What we need for that, well, we certainly need a recovery strategy, but we need a green economic recovery strategy, which is sustainable. I'm putting all the buzzwords in there because all these buzzwords will be important when we go forward. One, to decide the strategy, and two, to attract the money to pay for that strategy, and in a way that doesn't add to the debt of the country. It could add as well, but as long as it keeps the businesses functioning, the economy moving, then it's okay. I put together sort of the objectives of debt management strategies that they need over here. Achieve, so we need to get something that needs to be done, which is growing the economy, right? We need to improve the kind of borrowings that they're doing. They need to reduce the cost of that, where they're borrowing from, what conditions they're borrowing under as well. And then thirdly, you need to ensure that there's no point in putting more money in if no point in opening a tap for more water if there's still a hole. It'll just keep seeping out. So we need to also make sure that you need to rationalize, make more efficient government spending, but also substitute and augment that with private sector funding, which everyone speaks about, but no one really speaks about how to do it. So rather than money coming to the government, them funding the assets and thereby increasing their debt, why not create the conditions where the money goes directly to the projects and there is some kind of a support by the governments and the multilaterals within that. So you can't see it behind this, sorry, but basically there's 5 areas that I've looked at, and I've said that, look, in order to make this a sustainable and a long-term fix within that, and I have taken the SADC region as a whole. I take Cyrus's comments very well for Jan earlier on, but I guess this is a situation where united we stand and divided we fall. I really feel that. And if you look across the world, ASEAN, EU, and other places, they are all coming together to ensure that that happens together, because I think that's the only way that will function well. So the 5 areas: catalyze capital resources, get private sector money in. We want to look at competitive growth positioning, contingency planning, and so forth. So define. So I'll just quickly run through these and buzz me in case I'm going over the top and over time. Sorry. Right. Oops. So let me start with the catalyzed capital for green growth. So as I said earlier, there is a global market which is out there, which is looking at Corona bonds, looking at investing in this. The reasons are very good, actually. The fundamental reasons why a Corona bond market is booming suddenly is because there are revenue streams. Okay, within, and again, Barry spoke about this earlier, but there are revenue streams from projects that are going to be invested in or taken care of. So there are bonds that are catering to that. Bank of America is issuing a private sector bond, and the money from that is going where? It's going into healthcare. Well, guess what? Healthcare is a growing area. It does have revenue streams within that. And so it makes sense to invest within that. The difference today is that within the COVID bonds, the return expectancy is much lower, because in my view, the awareness about the social impact is much higher because of the COVID situation. So that's why I say that there is an opportunity within this as well. Why don't we issue, for example, like a Sadiq COVID-19 sustainability bond? The EU has taken from March till now to actually get that together, because while Italy, Portugal, Spain did it, the weaker economies, France, Germany were totally against it, because again, they felt that they would be funding they would be funding the poorer economies, as it were. But I think that the SADC could really do something with that as well. They could issue a bond in the market. And the key to that is the third point I put in there, which is the multilateral credit enhancements. There are global capital markets out there that can finance this at a decent level, right? This is key, at a decent level and at good terms and conditions, with a certain amount of time, grace periods, so that they're not running to pay back principal and interest. Also with revenue guarantees, for example, or guarantees in terms of liquidity facilities and so forth. All of these things multilaterals have started doing already in other parts of the world. Southeast Asia is a perfect example of that. So with those credit enhancements, what you can do is you can take these bonds and go to the global capital markets and attract money from there for projects. So again, not going to the government, but supported by the government and going to the projects. And those ones which are basically producing revenues. So what about the ones that are not producing revenues? Well, that frees up government money to go towards those. If their infrastructure has been financed directly, then they have free money to then go and spend on the other side. That should keep a lid also on the overall borrowing that they should need within that. So the paper speaks about this a little bit as well. The second part that I had spoken about is competitive positioning. COVID has a lot of opportunities, opened up a lot of opportunities, as I mentioned. I've, in the paper, spoken about the Portuguese model. What does Portugal have to do with SADC? Surprisingly, a lot. Portugal has always been the most difficult part of Europe. They always need to be helped. They're bad GDP, bad infrastructure, poor policies, no money. Their debt to GDP levels were over 100 for a long time. And over the last 4 to 5 years, what they've done is fantastic. And today, this year or next year, they're expecting to be debt zero. So that bears, looking at, certainly. So I put that in there. And the way they've really done it, very simply, is they've made it interesting for people to come there and set up business. They become like an IT hub and a tech hub, basically, which they never were. Number 4 in the world from being nowhere, right? So why doesn't SADC look at that? And when you look at the SADC region, there's a whole variety of things that are happening there, okay? Most importantly, I think the tourism industry, when it comes back, is going to be very important. It still is important, but the new adapted COVID-19 style facilities, very much so. People are looking at nature. They are looking at getting out into the open, into wildlife, and so on and so forth. So that's getting much more interesting. So why not make it a hub, right? Why not do it for the whole region as a hub? Healthcare, because I work a lot with the WHO and with other healthcare groups. Healthcare within the region is very strongly needed. Not there yet, but strongly needed. So South Africa, for example, has the only PPP in the world, as far as I know, which looks at vaccine manufacturing, okay, BioVac. Now, those kind of things are very highly needed, and I spend the other half of my life speaking at local manufacturing discussions. So we've had ones recently across Africa, Tanzania, North Africa, South Africa as well. With the whole COVID thing, because of supply chains breaking, et cetera, there's a need for local manufacturing. Not only is there a need, suddenly the multilaterals, suddenly the foundations, and suddenly also private sector money is saying, okay, we understand that if problems happen, that 60% of vaccines are being made in India, they can't come from India to Africa, and then we're stuffed. So we need to have those in Africa. That manufacturing hub needs to start coming to the SADC region. And they are actually fairly well equipped for it. If you go deeper into it, and I've done research into that, there's a lot of stuff that they can do there. You know, again, South Africa and other parts of the region also are being very famously in the newspapers these days about the vaccine tests and so forth that are being done, staged clinical trials and so forth. So why not bring those? And I've listed a whole bunch of them over there, which, you know, you can go into in the paper. But certainly as climate becomes important, as research becomes and education becomes important, large part of this area is very important for that, because if you think about the biodiversity in the area alone, why don't we have enough universities about that people will come there? Education as a business as well, attracting money in to make this business economy function for the sustainable long-term debt management of the country. So again, I'd urge you to have a look at that. And so I've suggested this SADC hub idea as well. Oops, it doesn't like me. Right, so moving on from that, then, so those are two areas that we've already looked at. The third one is about correcting fiscal. So as I said, no sense in not using what we got, plugging the holes and using the stuff that we have right now with us, right? So savings for rationalizing, you know, I don't think we need to speak long enough about this to know that many of the public sector units and businesses that are there in the region are hemorrhaging money. And that's because of inefficient use of that. So let's try and tighten that up and make the savings a bit more so that the spending is not as high. The requirement of spending is not as high. So that is the one area. The second is, and someone's spoken about this, these debt for nature swaps. I'm a big believer in them. We worked on them in several cases. Madagascar, I think, did one as well. In Asia, they've been pretty popular as well. And I think that now, when there's an awareness on one side of COVID, about healthcare, about the climate, I think these swaps are perfectly there for region. And the region are, of course, biodiversity, forests, oceans, everything is there. So I think that they should benefit from that, where they say, look, no one's going to go out there and say, okay, we'll just release all the financing, the lending that we given to you. We won't forgive it. China certainly will not. And, you know, speaking to Jan's things earlier, China will have a double effect. You know, if it's lent 100 billion to a region, all that 100 billion is going towards Chinese companies who are actually building most of the time. So not only do they lose out on the lending, they'll also lose out on the money that would have gone to Chinese companies. So it's not going to be that easy, but these kind of swaps would allow for something to come together, climate and debt. So I think that's a really good idea to explore much further. And I think that there's a lot of appetite for it also from countries. Asset recycling is the third one. Australia, India, and other countries are very big on this. You know, we've got the assets. They're usually in extremely bad condition within the SADC region as well, and many of the SADC regions. So there's a double benefit to doing that. Why not on one side? This is not privatization. This is quite important. We're not selling the family jewels. Mostly they're going to lease it out. So lease these out to a private operator who comes in. There's a revenue stream already because there's a population already in Africa that is using these utilities and so forth. So it would be easier for an investor to come in to operate that, take it on lease for X number of years, and not only then take that debt requirement off and, you know, servicing requirement of the government, reducing their debt again, but also they would do up those utilities to make them better. And yes, there would be some kind of a user charging on that. But then the government money, instead of going there to service the entire utility, for example, would go towards maybe viability gap funding it. So again, I think that, I've suggested something like that also within the paper about some kind of a SADC asset recycling viability gap fund, kind of a hybrid between a recycling fund and a viability gap fund, to try and basically use the money that the budget has, not for going and spending on the assets, not for servicing it, but doing enough of it to take the risk out to get the private sector on board. And I think that multilaterals need to play a much bigger part within that. And certainly they are doing so in other parts of the world. I know I'm running out of time, so I'll try to be quicker. Contingency planning. Okay, no point in doing all of these things if 1 year down the road, we have another catastrophe and you're back to zero again. So catastrophe planning is extremely important, I think. And we've been working a lot with ADB, with AIIB, World Bank, IFC, and all these guys looking at catastrophe bonds. So I take the point that Barry mentioned about catastrophe clauses within contracts, but there is no reason, as we're speaking at the government level, that the governments cannot, along with multilaterals, get catastrophe bonds issued. They're being done across the world at the moment. Mexico, Argentina, World Bank is very active in this area, and I'm sure the African Development Bank could be as well. I know the Islamic Development Bank is looking at an Islamic version of that as well. So why not have that, not just as an insurance mechanism, a cat bond, but also as a financing mechanism. If everything goes to pot, money flies in. Money flies in to try and recover the economies. So all the work that we've done doesn't go to zero again, but is held by this kind of an insurance behind it. And catastrophe bonds are really getting much more exciting about that. And they can take a much wider kind of look at the region as a whole, because the diversity makes the risk a bit lower. So I think that's not a bad way to look at things as well. And there are hybrid models to reduce the cost of that. So then all the governments are paying for is the premium for the cat bonds, premium for the insurance effectively, not having to deal with the entire catastrophe when it happens. So that's something that we should be looking at as well. And then finally, de-risk models of infrastructure planning. So, we cannot discuss this without PPPs. There have to be public-private partnerships. There have to be pooled funds out there, because let's be clear, these are small kind of infrastructure projects. These are not the traditional things. So you need pooled funds to come together, one, for actually the assets that you want to invest into, but also for the investor bases. The investors are willing to come in, they want to fund these things, but they need the one-stop shop, right? So you create a fund in the middle, some kind of a pooled fund where money come in, and things like this are already happening in places like Tanzania. There's been a lot of work done on that with the World Bank when I was out there, and Magali should know about that as well. Municipality bonds and pool funds are being sort of pushed with that. So blended finance, another very important part of this. I think the concessional financing, again, let's use the government money not to raise our debt to try and save the region, but to try and fund the risk, or even guarantee the risk so that the private sector is willing to come inside. And again, multilateral banks, African Development, World Bank, IFC, MEGA, all of these people will play an important part in that for any strategy as well. So I think I'll end there. That's really what the paper is about. I hope you find it interesting if you get a chance to read it. And I would love to hear anything back from yourselves as well, and feedback as well. So there you go. Thanks a lot.
Great, thank you, Amitabh. Lots of interesting ideas. Let's go to our commentator, Anuj Mehta. I can see you're around. Great. And I know this is extremely late for you, so we appreciate you staying up long past your bedtime, I'm sure. But the floor is yours.
Thanks a lot. It's precisely 11:11 p.m., which is an interesting time. No, good. Thank you very much to all the presenters. I think it's been a fascinating, especially seeing all the papers together really sort of helps me understand what all the different, it really fits very well together. So I hope you can hear me, Daniel.
Yes, we can hear you.
Okay. All right. So I'm quickly going to sort of give very succinct points, and let me give a bit of a perspective on myself before I start commenting, in the sense that I sit in the Asian Development Bank in the Philippines, and my precise focus is to try and help governments leverage their funds better for green finance and sustainable climate based recoveries. So it's heavily focused on innovative finance. That's my focus area for the last several years over here. And so my thought is always about practical issues for the future and how you solve those issues. So, I'm going to sort of very quickly skip through all the different papers, start very much with the first paper, which was very nicely presented by Jan. Thank you very much, Jan, for your paper. And I liked, so I'm sort of just going to very quickly talk about the points that I think were super interesting and where I think things need to be strengthened according to my perspective. The paper on sovereign debt through the lens of asset management was super interesting for 2 or 3 super useful areas, which is the whole lens of trying to bring a focus on assets and the public sector balance sheet versus the conventional debt to GDP ratio. And I think that's a very important distinction to bring up. The paper brings it up very clearly and tries to shift focus onto assets and how useful that is rather than the prism of simply debt to GDP. I think that's number one. I think that's a very useful thing. I think there's a lot of interest in, I was particularly interested in the whole focus on settling the issue of the Chinese debt in Africa. And I think that was a very, very good effort made in the paper to try and bring a focus on that. I think that was very good. And especially trying to bring the focus on infrastructure as a huge investment. I think that was super interesting. And then I really liked the 4 areas that were spoken about, which were the liquidity support, the patient capital, debt for climate swaps, and asset-based refinance. So, from those perspectives, the paper was very well put together. It enumerated the arguments very well. I guess from a strengthening perspective, when I looked at the title of the paper about asset management or sovereign debt through asset management, what I would have loved to see a lot more, and where there is a huge gap in knowledge in the market, is asset management, is how do you treat the asset? And the paper speaks almost towards the end, almost in passing, about asset recycling and debt swaps, etc. But it's I would have made that a lot more central because eventually the flow of the paper, I think, would have been better served if how the assets are treated, valued, had also been bought in a little bit more. So when I talk about infrastructure, which is my area, there's a big debate about valuation of infrastructure. And I would love to see something more about how do countries value their infrastructure. So it's fine, we're not talking debt to GDP, that's okay. But if you're talking about the assets that have been created, then what are the ways of valuing them, number one? Number two, sustainability. And this is the single biggest issue that I saw in the paper. All the multilaterals, China is in the same vein, have all been financing capital expenditure infrastructure for a number of years, and that's a good thing. But the issue is sustainability of those assets, number one, and number two, the fit. So, given that you're specifically talking about China infrastructure investments, which clearly has, sort of a lot of good connotations, you also need to talk about the process on how that debt has been put into infrastructure. So there, the whole issue is of capacity, the sizing of the projects, because the biggest criticism that the World Bank had back in the 70s was that too much money was being invested in massive projects. So, the biggest example that comes out for China is the Tanzania port project, $10 billion. I mean, I haven't seen port projects of that size in Southeast Asia with much bigger countries and demand potential. So the issue that's going to come up is not simply of financing infrastructure, but financing the right fit of infrastructure with the right projected period, and especially sustainability. There's no point in spending billions in building capital assets which you can't even pay the O&M for. And that's the whole debt trap issue, which needs to be addressed, especially if you're going to bring such a big focus on China. And I'm sort of making the points over here. I think the investment itself is a good thing, but these issues and criticisms will come up. So I think sustainability of infrastructure, the right sizing of the investments made, value for money, the process under which such investments are made, and the single biggest thing which should be there as a metric, which is EIRR, economic rate of return. So if something is being invested for a particular project, does it actually have any benefits, or are we building an airport for 30, 50 years away where there are going to be no revenues? And I think that's the single biggest issue. I think if you're going to talk about examples like Hambantota, I think you need to also, I think it's going to be a challenge to simply say that that the concession was done at the request of the government. I think there's a lot of literature about Hambantota and a lot of criticism. And so the fact that they're delinked, the lending and the concession agreement, that needs to be brought out a little bit more, because that will strengthen your argument actually. And especially that. I think the last thing I think is it would be good to have a little bit more in the way of case studies or examples for some of the issues that you'd put at the end, such as asset recycling. I know that in a situation with a massive amount of debt strain which these countries are facing, and I believe that the projected amount is 77% projected GDP. Asset recycling is the single biggest issue which actually we need to talk about for sustainability of or getting over the crisis. But what is that asset recycling? And I know in my discussions with the finance ministry in Indonesia and in Vietnam, it's not so simple. I mean, is it privatization? Are we trying to do something with capital markets? I think that if you could strengthen that area of asset recycling, I think the paper would be more balanced rather than only focusing, as it looks right now, very heavy on China debt investments in Africa. So, that's my sense. I think it's a super interesting paper. I was very interested to read about your perspectives on the investments of China in Africa. And I think these are some of my suggestions which may help strengthen, but of course for your consideration. I'll stop there on the first paper. Daniel, do you want me to keep going on the other papers?
Yes, keep going and do all four. And then what I encourage participants to also start putting their comments in the chat box and questions, so we can come to that afterwards. But Anuj, keep going.
All right. Now that I'm in a flow, I'll do that. So the other paper that I was very interested. So I actually read three papers: Jan's paper, Amitabh's paper, and Martin's paper. So I'll just now I'm not an expert on the IMF, and I found the IMF paper fascinating because it focused, especially on not necessarily the liquidity rescues, but their surveillance work, and made recommendations. So I really like the flow of the paper. I really like this focus on what I thought was more of a niche area, and the analysis which had been done to actually show that 5 out of 6 cases there had been warnings which had been put in place, which came good, as it were. I like the fact that there was an enumeration of the fact that the IMF as a neutral agency was willing to be critical, and I actually like that point because in a lot of international financial institutions, the punches are held back a little bit, and I think this was nicely brought out. Now, I guess my one issue that I would have in terms of where that could go a little further is we had discussions with the IMF on innovation and how what they do on evaluation and surveillance could actually go a little further towards helping countries strengthen their management of, in this case, I guess it's debt, but some strategies or some support, and especially some capacity building. And I think when we were working in this area about 5-6 years ago, when I was at the World Bank, there was a lot of discussion on shadow ratings or shadow surveillance aspects, which are only shared with the countries and which could proactively help a country and say, look, you're on a path to basically being marked red. What could be done to improve you? Here are 3 issues, and here are some capacity support, development issues. And they were as simple as financial management systems, which could assess, maybe like Jan's point earlier, the valuation of your assets. Let's make that valued and try to do something with it to monetize assets. But I think that was my one takeaway from the paper as a suggestion. But otherwise, I found the paper super interesting with, and Martin's presentation was also lovely actually, and brought that across very well. So nothing further to say there. Now, Barry, if I can quickly shift to Barry, I'm sort of running through the presentation, so I hope you get my my points. Now, Barry's paper I had not read because I thought I was only supposed to read 2 or 3, but I eventually was also looking at the presentation. And I think if the points are the same, then I have these 2 or 3 points on Barry's paper, which is a big good focus on the debt problems which are caused by the pandemic, on revenues, etc. And I really liked your focus on what's being offered and what's needed, and that's beautiful, because that's kind of sort of shows where the gap is. The question I think I had, and I think you brought it out very well, is no thinking of the long term, and that was I think that's exactly right. But the issue is on the recommendation side. Now, because I saw, for example, that you're talking about grants and not a lot is flowing, and I think the implication is that a lot more should flow. And also in terms of your revenue bonds, on the other hand. So there are 2 separate recommendations, if I get it right. One is more grants to flow from multilateral financial institutions, and the other side you've got these bonds. The bonds idea, really good, because you're trying to link, or you're trying to push the envelope for governments to do not general bonds, where they are raising money and then basically getting a hit on the balance sheets, but project bonds, project recourse bonds, or project revenue payment bonds, if you like. And now that, I think that is very apt. With grants, there's a fundamental issue in terms of how the grants are used. And I fear that could be an area which could get picked up as throwing more wasteful expenditure into governments for things like income transfers and things like that, which load up the balance sheets, but not necessarily productive investments. And I add infrastructure to this, that investments which go into white elephant infrastructure is also going to be a waste of time. So, and this is such an important point, because even today within the ADB, we are talking about how do we better use our grants as impact funds. So not using it for CapEx, but using it for de-risking, or using it for something similar. And that would be something useful for me to see about how could, it's not just the issue of more grants, but the use of better used grants for projects, for countries, to try and improve their debt sustainability issue. One thing that I felt also, Barry, in the paper and the presentation is, and across I think all the papers, there's a lot of focus on debt management of the governments caused by COVID and so on and so forth. But the issues, the structural issues, have always been there. COVID has just made it a little bit more of a time to actually suggest a green recovery or something like that. But the fundamental issue is that there aren't enough systems which actually measure, the great point Jan had, the valuation of their assets, or I would say monetization of the assets. Why, how do you capture that? And then the whole point of planning of the use of funds so that there is real impact and real sustainability. Now, I think that's just got accentuated with COVID, but the issue of debt management and how funds were being used to invest in projects, I think that's a fundamental issue which perhaps needs a little bit more of a highlight. I'll stop there on Barry's paper, which was again super interesting, and I really like that comparison between the problems and what's needed. And lastly, Amitabh's paper, which obviously sort of is hugely relevant to me, because that's exactly what I focus on, the green finance work in across ASEAN. And great structure, I think the great flow. And I think, the context is very nicely brought out there. I went through the paper in a lot of detail because I work on this area so much. And I like this, the fact that you went from context to very clear objectives, your AIR, I think it was, AIR, improve, reduce. And that's important, because when we look at, for example, what's being tried in the economic zones. So it's not just about the immediate debt management, but how does a country make revenues? And this is going to be so critical to healthcare, tourism, as you rightly brought out. We're talking about economic hubs for vaccine manufacturing in Vietnam right now. And countries need a push for something positive such as like that. How do we generate revenues? Kazakhstan, we were talking about the logistics hub, as simple as that, as well as this whole issue of using their existing assets. Asset recycling, I think, was the example you brought, which I think is important to bring out. So I think those were really good points. The flow of the paper is nice. It leads very nicely from objectives into activities. I think where it could be strengthened is in terms of some more of the challenges which are faced with some of the examples you brought up. So for example, bonds, COVID-related bonds, yes, very important, but at the same time, there's a tendency for governments to try and raise money from a COVID-related bond, but not entirely sure of how to measure the framework for making sure it goes into the right type of projects. That's been a massive challenge because everybody talks about green, but everybody doesn't want to use the green frameworks, which, for example, the EU has. That's very important. The capacity of governments, again, when we're talking about sophisticated instruments like asset recycling or debt swaps, I mean, the debt swap example, which was done, for example, in Africa, I think it was done in Africa or South America, that was with the help of USAID, which sat and prepared that one transaction. In Asia, with local governments and with national governments not necessarily having the capacity to leverage, creating the asset recycling models also needs to be improved. So what I would say is in the paper, there needs to be something about the challenge in implementing this, such as capacity building. Doesn't have to be in great detail. And I would also probably put some of the suggestions which you had on those 5 prongs, maybe from simple to complex. And why I mentioned that, different countries, different solutions. So where Thailand and Malaysia are today, some of the solutions would be more apt versus, for example, Cambodia, Laos, right, or Bangladesh. And so different things would need to be suggested there. I think those are my quick takeaways. I apologize for not talking longer because there's been so much rich material from all the speakers, and I hope that's useful. And I'm happy to give more suggestions by mail or something like that. I'll stop over there. Thank you very much. Back to you, Daniel.
Thanks very much, Anush. I just should add our second commentator today. Unfortunately, there was some confusion on dates and times, and he's actually teaching a class as we speak, and so isn't able to participate. But it said he will send written comments, so we'll pass those on to people. These have been 4 very rich presentations, and I have lots of thoughts and comments. But before I give comments, I thought our audience has been extremely patient listening, and I'm sure also has lots of interesting comments. So, if people would like to either submit comments or to raise their hand, and for this purpose, I think also the presenters should treat themselves as participants and feel free to either respond to the comments that they've heard or to ask to make comments on other people's papers. But let me open it to the floor for a bit and then see if there's some people in the audience who would like to either submit their comments in the chat box or raise hands, and then we'll call on you to make your comments, observations, ask questions. So let me open the floor. Anyone? And as I said, that includes the presenters as well. If you want to hop in and ask questions or make comments, feel free. Barry, it looks like you're raising your hand. I'm assuming that
I wasn't sure what that symbol was. So, but
that works just as well.
Okay, so I could start it off maybe. Yes, very interesting papers. I think you're going to end up with a nice publication when this is finished. First, something maybe on Kevin and sorry, this is embarrassing.
Yeah.
Yes, Professor Yan Wang's paper. I think the idea of looking at public sector balance sheets is interesting, but I think there's an opportunity they should maybe take advantage of. So there is, on the one hand, they critique looking at the public sector debt to GDP ratio and say we should look at public sector net asset position. And I think that's right. The main value there, however, is in budgeting. So that, for example, you need to maintain the state assets. And you need to put money into them and so on. With regard to debt crises, however, the usual concern is on external debt, and there the external assets. I mean, unless you're talking about selling the national park to some foreigner, you're really not going to use let's say most of the assets, publicly owned assets, are not relevant for settling a debt situation. Usually, people look at gross debt minus reserves, foreign exchange reserves, and so I think putting some emphasis on how you would use the public sector balance sheet is relevant. And I would not, I mean, I would not use net asset position if, without taking account of the currency mismatch problem and what's liquid and what's not a liquid asset. On Martin, one thing that you might add that on surveillance is that the IMF last year adopted a policy on social spending, and they are now supposed to pay attention to the sustainability, the adequacy, and the efficiency in social protection, in education, and in health. And I think it is important to sort of highlight that, that this whole business of the fund and austerity and adjustment on the backs of the poor is something, that should also be addressed. Now, the fund is going to prepare a guidance note on implementation of its policy on social spending. It was supposed to be ready by December, but then came the pandemic, so forget that. It's been delayed. But I think that's something maybe to add. And also that as part of this discussion in the fund, they have actually opened themselves up, or at least proposed that they have a dialogue with with civil society and trade unions and NGOs and so on. And I do some work. I sort of part of the Global Coalition on Social Protection Floors, and it's one of the things we're interested in, which is to say pushing the fund to be more socially responsible. And let me just make a quick comment on cat bonds, catastrophe bonds. It might be worth asking, why is the World Bank never going to do another pandemic bond? Amita, that's and this may be a question of the cost and the funds sitting unused and so on. And lastly, on the last comment on Anush, The grants I had in mind were for catastrophe use, for imports of PPE, for food, for cash transfers to the poor. I mean, these are for expenditures, current expenditures the government does in the middle of a catastrophe. They were not slush funds and so on. I need to clarify that. But I share your concern. Anyway, so thank you. That's it for me.
Thanks, Barry. Jan, I know you want to respond to some of the comments, but before I give the floor to you, I just want to check if there's anybody else in the audience who would like to say something or has a question. Amitabh, it looks like that's a hand raised. Go for it.
I'm sorry, I had to use the normal way. I have no idea how to make the reaction thing work on this. Barry, thank you for those comments. Actually, that's very good. The pandemic bond, I'm working very closely with that for quite some time, actually, prior to the COVID situation. So I was very excited about when it came out. I think it's not just about a pandemic. It's also about the other things that are happening. And if you look at the problems pre-COVID in the SADC region, El Nino, and other kind of problems, catastrophe bonds will definitely help that. The reason why the World Bank is not doing a second one is fairly simple. I think that at the moment, there are plenty of other people doing it, which is very good. The idea of the World Bank and others, in my view, is to catalyze other people to do things who were not doing it before. So I think that's one reason. The second is, of course, that the triggers, etc., didn't work very well. Easily fixed, right? COVID only started paying out after several months. So that was obviously an issue. But I don't think there's anything fundamentally wrong with them. And I think it's a good idea. The cost is the biggest prohibitor. No question about that. However, I have just designed for another financial institution, we just designed another product, as it were, a hybrid cat bond. I'm very proud of it, where basically, the cat bond is expensive, 10, 12%, because the outcome is digital. Either you pay out and lose all your money, or you don't pay out and you make your premiums, right? If, however, you take it through the process and you understand that that money is going to be used by the government to actually invest in various companies to aid the recovery, because it was for a recovery bond, why not convert the money going in from a cat bond, so a cat bond investor, his money, in the case of an event of a catastrophe, goes into investments into different kinds of businesses and so forth in the economy. Thereby, the cost is removed because you're not losing the money. You're in fact doing exactly the same thing as you were going to do, but through the government. And so the price can fall to something like 3 to 4%, according to sort of modeling that we've done. It's very interesting. Sorry, I don't want to talk about cat bonds. I love the things. You were talking about Islamic Development Bank, also very, very interesting that they are looking at that too. Jan, maybe a quick comment on yours. I really enjoyed your presentation actually as well at the beginning. It was a good kickoff to get us all in the mood to do these things. I share Anuja's concern actually with the Sri Lankan port and with Pakistan and with others, because there's been a lot of controversy around that and how that came about in terms of in fact that particular one has been so highly highlighted everywhere as the way of extended Chinese rule or sovereign kind of expansion. So that particular one, maybe you can use a different example, because that one has been really in the press destroyed out there. So anyone reading it could be incentivized by that or not. But I think in general, I think the idea is very, very fixed. I like the idea of valuation. But again, my issue, because I come from the investor side, I was investment banker for many years, and then with the UN and with the World Bank and others, my issue is always, who are you doing the valuation for, right? We're doing the valuation, the debt GDP ratios, etc., are used by lenders. Now, let's move sovereign lenders out the way. Let's look at the private sector, the capital markets and so forth. To convince them that they should look at wealth rather than liquidity is going to be pretty difficult in my personal view as well. I totally subscribe to your idea of the valuation, but I think that as we are aiming it towards them to convince them that, hey, listen, we're not as insolvent as we look, I think that liquidity still remains the number one issue within that. So it's going to be a long term, and I think Cyrus was mentioning that's going to be a longer term thing, but that doesn't mean we shouldn't start it now. Let's start an alternative valuation methodology out there. And as with many of these things, no one's ever suggested them before. So let's do it. Let's get it out there through this book, hopefully. This could be the launch of the IMF Challenger, as it were. And I think that could work really well. So I think maybe if you tighten that up a little bit, maybe put, this is how it could work. And this is why it's important, even though it's a valuation tool and not a liquidity tool. Well, valuation tools are used by other kind of investors. It doesn't need to be, capital market investors. It could be sovereign investors and so on and so forth. And global fund, not global funds, sorry, sovereign funds and things like that would be also interested in the valuation methodology. So maybe we can split the market into two and have a valuation for this, for these guys and for that. And I think Portugal has done something like that as well, very much so. And I think they've not only done it on backward looking assets, they've done it on the expectancy of future assets. Super interesting. We're building the business here and the valuation of this business in the future is going to be much higher. And so we should base it on future values. Fantastic idea. I like that. So thank you for that.
Thanks, Amitabh. Jan, just before you, I'm going to keep my comments till after you, till you respond. But I just want to add one issue on your paper, and then I'll talk about the other papers afterwards. Is on China as patient capital. Because one of the issues with China, as everyone knows, is the transparency of Chinese lending operations. And what I'm wondering is does that mean if it's patient capital that it's mainly in the form of project financing or linked to some sort of commodity or some particular stream of income? And so in a way, it's securitized or collateralized and it's different from other forms of debt. And that's going to complicate the DSSI and whatever other negotiations there might be going forward in terms of debt. So if you can just add that as an issue to think about it. I know that it relates to Barry's paper as well, but seeing your paper raise the patient capital issue, I thought I'd ask you about that.
Thank you. First of all, I want to thank all the commentators, discussants, Cyrus, Anuj, and Mehta, and regarding my paper. And due to the time constraints, I didn't elaborate on the idea of asset-based refinance. So I want to have one elaboration. In my paper with Kevin, we gave an example. If an internationally financed infrastructure project, which has already completed and form a public sector asset, if it is 100 million, for example, and if the host government has already repaid only 30%, and currently due to pandemic and the government cannot continue to repay, so the government has already 30% equity in that project. And then multilateral development banks or any bank, original creditor, can design an asset-based refinancing scheme to use the 30% equity that government has as collateral to issue new financing in the amount of 30%. So that is quite a valid approach. And in the past, asset-based finance has been used in the case of Angola and so forth. So this is not completely new, but we are saying that in one infrastructure project, which 30% owned by the government, and the government can use that as a collateral to get the refinance, and so that new liquidity can be attracted to the country and without hurting the country's credit rating. Regarding the patient capital and footloose capital, many participants in the other seminar also asked whether patient capital and footloose capital can be treated differently in that restructuring. I think it should be treated all equally. But patient capital holders are those bilateral governments and state-owned banks, multilateral organizations such as the World Bank, regional development banks, and the sovereign wealth fund. And those are patient capital holders, and even include some pension funds, large pension funds, Norwegian's pension fund, the world's largest sovereign wealth fund. So you can utilize those sovereign fund and patient capital holders to address your structural problem and enhance your capacity for export. And I agree with Meta that we should work on these valuation problems because for green investment, you need to value the green assets of the country. So for example, forest and pasture land, and also the established already completed infrastructure, you need to give a proper valuation. We must agree that capital market is not complete in all these areas. So we need to give a proper valuation, and there may be different valuation to different group of countries, to patient capital and to local investors. These green assets may value higher, and to footloose capital holders, they value the asset lower. So this is a big challenge, how to value these green assets.
Jan, could I just say something very quickly that you could maybe add into your thing when you were speaking there? When we were working with the bank in Tanzania, it's very interesting that the pension funds, the pension fund market there's quite big, and it's all, of course, government pension funds. And they all they've been consolidated into 2 or 3 now from, I think, 12, whatever it was, something like that. We had discussions with them. They have no assets to invest into. So when you're talking about patient capital, you actually got investors like in Tanzania sitting there, and I'm sure it's similar in South Africa and other countries as well, with no assets to invest in. So they were actually going and buying chicken farms. This is not a joke. Chicken farms, so they could create an asset to invest into. So maybe, working within the region, and of course, pension funds can't go out of certain regions and countries, of course, but maybe that's something you could add, that, within those patient capital, investors, something like the Tanzanians, public sector pension funds could be targeted, and assets could be built in a way that they could invest within that, because they need investments and they need assets. So just as a thought when you were speaking there. So.
I totally agree with it. So once I presented some ideas to the Kiel Institute, and an original IMF official said, we don't know how to value these assets, especially the so-called green assets. So this is a market failure because we don't have a good method of value the green asset. In any way, there are so many sovereign wealth fund and the green fund. We must have a good valuation of these assets. So I'm suggesting a very narrow part, which is the one completed project, partially paid by the government. Then you can value this quite easily by the amount that repaid already by the government. Very easy to value this. So I will stop here because of time.
Great. Thanks, Jan. I know I'm aware of time, but I think we have one question. Yes. So Junior Zongwe has a question. Junior, if you want to unmute yourself, why don't you ask the question? If you can unmute yourself, if not, I'll read the question for you. There you go.
Yes, thank you very much. Can you all hear me?
Yes.
Yes, I did see from the comments, the answer from Professor Yan and the comments made earlier about the resource-backed deals. I have a keen interest in those deals because it was even, apart from my research, it was also the topic of my doctoral research. And one of the things that I've noticed in the literature is that it is mostly presented as resource-backed deals. But when you look at the few instances where the terms of the deals were presented, the natural resources were actually the mode of payment. They were not collateral in case performance fails. So my question to Professor Yan, and that also speaks to the issues raised before, is what is the legal basis for presenting those deals as resource-backed as opposed to resource for infrastructure contracts? And I have to maybe add a follow-up question in the sense that the implications are huge, even in terms of debt, because as Professor Yan has correctly put it, asset-backed finance is not new. But this kind of investment that involves barter seems to be less common, and that would be one of the implications, of course. In terms of debt, it will also have some implications. But again, I would like to hear from you and hear what you have to say. Thank you.
Jan, did you have a response to that, or anybody else?
I want to clarify that our proposal on asset-based refinance is different from the so-called resource-based finance for infrastructure. In the book, Justin Lin and myself expressed our interest in the resource-based finance for infrastructure because these projects have reduced transaction costs because it cuts across different sectors. The resource extraction may be one sector, and the infrastructure building is another sector. The contract linked the two sectors together and make it work for developing countries. The book concludes that in resource-based infrastructure contracts can bring the infrastructure faster to developing countries to benefit the developing country people. But for my proposal, asset-based refinancing, it's very simple. It's just one project, one infrastructure project, such as a bridge or a power generation station that is $100 million, and then half or 30% has been repaid. This 30% can be used as the equity collateral to finance to back up the refinance loan. So it's just 30%, like 30 million. Very easy to calculate.
Just to add to that as well, Dunia, you were asking about the legal part of it. So the difference is, so I used to 16 years of doing securitization and structured finance. So, you know, asset-backed lending, asset resource building, revenue asset, all slightly different to each other. And, you know, the risk is, of course, where the issue, the differences are, right? So if it were a securitization, that you have a project securitization, you have an SPV, legally a separate entity from the government. So the SPV has the money coming into it. It can be the equity from the government that Jan is talking about, plus borrowing from the markets, from commercial, from you, me, anyone. So that SPV would be bankruptcy remote. It would be far away from the government. That's important for investors, don't forget. And of course, the asset is then owned on the other side by the SPV and thereby the investors. That's your securitization typical. When you're talking then one level down with asset-based, and it really varies because it's all structured in the way that you want it. You can find two deals which are slightly different. In some cases, the asset may not be owned with the SPV, but the asset may not be owned, but would have beneficial interest. So whatever comes out of it will first go. So it's like a waterfall that you get paid first, but you don't own the asset. The asset remains with the government, as an example, right? And then the third level, where I think is what we are talking about here, where the asset is not in an SPV, it's not separately put necessarily. It could still be within the government, but the funding is going directly for that. It's earmarked for that. But then the risk still remains, most of the time, of the government. So it really varies. And I think the way forward on these things is to see which version of these is attractive for investors. What makes it bankable, right? This is the word that everyone loves to use. I love to use it too. What makes it bankable? If a separate entity exists and owns the asset or has some kind of beneficial interest, that's already a step away. That's already very attractive to investors. And there, it's much easier to do what we were suggesting, what Jan has been suggesting, what I was suggesting, what Barry had suggested as well, that you can have multilaterals coming in and giving it guaranteed support. It can have first loss catalytic pieces within that. It could have the 30% of Jan's and so forth. So legally, it's always better to have that separated in an SPV, separate monies coming, separate monies going in, no government control per se. I mean, of course, you'll have some degree of that, but it's the next generation of PPP in many ways, one step ahead, just so that it is attractive for the risk-wise, attractive and legally attractive for the investor base. So that's the legal part of, I just add to what Jan is saying there as well. So.
Yes, if I may, that much is very clear. But yeah. My question, I should have phrased it a little bit better. What I was saying is that in the so-called holdback deals signed in Angola, in the mining deals signed in the Congo, and so forth, they are presented as asset-backed deals. But is there any evidence in the documents? Because some of these contracts were published by the government.
Yeah.
When you look at those contracts, I did look at them. And that also involved conducting interviews. I didn't see anything that presented resources as collateral or as security. And yet, in the literature, it is very clear that people are presenting it as some sort of collateral and security. So I fully agree with you what you talk about bankability, the special purpose vehicles, etc. But my concern was, where is the evidence? People say China is involved in asset-backed resources, but where is the evidence that China is using those resources as collateral? It's payment from the look of it. But I got your point very well. Thank you so much. Yes?
I think in process, it's the same.
Yes.
In legal terms and risk terms, it's totally not. Okay. So in the Angola deals, I know them also, by the way, the mines particularly. It's very clear that the risk, if you look at the primary risks in there, primary risk, government risk, yeah. Secondary risk and possible source of revenue stream, no ownership, revenue stream are the mines, right? So you're absolutely correct in that. Sorry, I have a legal background as well, so that's why I'm picking up on the nitty-gritty, but you're absolutely right. In process, of course, the revenues are going to come from what they're building, the bridge, the toll roads, etc. Ethiopia is a good example of that as well. Lots of deals there with China, lots of construction, all coming from streams which are coming from what they're constructing, but not legally put together. And one of the reasons why they say it's not done like that is because there isn't a securitization law that can often fit that bill clearly. It doesn't allow you to transfer assets that easily. Also, beneficial interests are not always easy to transfer under law. So until the law is not changed, they don't allow it. So I'm giving you the defense arguments. My personal view is if they don't, then we don't do it. It's as simple as that, right? So,
yeah. Okay, thank you.
Hope that answers it, yeah.
Okay.
Thank you. I recognize we're running out of time. I'm going to make a couple of quick comments, which I can then pick up with people individually. But I think on the Wang and Gallagher paper, we probably had lots of discussions. I think I'm going to skip that. On Martin Edwards' paper, a couple of comments. One is Martin had said that one of the functions of surveillance is to speak truth to power. And one of the things I always think about the IMF, like many international organizations, is that they're a lot weaker than they often appear. And that speaking truth to power often happens behind, or can happen behind closed doors, and we don't know about it necessarily. But your example of Tanzania shows how difficult it is, even in the case of relatively weak countries, to speak truth to power. And when you're talking about more powerful countries, the problem is only magnified more. And that leads me to my second comment about surveillance as soft law. And I should say soft law is a topic close to my heart. I've just published a book, co-edited a book on the topic. And it's intriguing to me that you think of surveillance as soft law, because in some cases, surveillance might have a compliance pull. If a country knows that it's going to be needing IMF financing sometime in the near future, then it obviously has to listen carefully and pay very close attention to the surveillance. If it doesn't think it's going to do that, it can safely ignore what the IMF says without any consequences, and even though that can have some serious problems for the global system. So if soft law is to be effective, it's in a differentiated way only for some countries and not other countries, which is an unfortunate form of soft law. So I think I would suggest that you should nuance it a little bit more than at the moment, just because of the problems that come up. And then finally, sort of to echo Barry's point, is that the IMF is changing, and in the course of this crisis is changing even more rapidly than it was beforehand. And so what role surveillance plays going forward might be different from what it was in the past. And it would be interesting to speculate a bit more about that, because I suppose we don't know yet exactly how that will play out. Barry's paper is an extremely interesting and thought-provoking overview of the state of play, I guess. And a couple of things. I was intrigued that in your discussion, you don't mention at all the international standards that are beginning to develop over time relating to sovereign debt issues. They don't have much traction at the moment, but I think they're important. It's important to at least keep them alive, because as Cyrus was saying, some of this is a long-term strategy anyhow. And so doing that, so I was thinking, for example, of the UNCTAD principles on responsible sovereign borrowing and lending, the UN guiding principles on business and human rights, which apply to all the bondholders, the principles on responsible investing, and we could go on. But they at least should be kept on the table as options for the discussion, even though I think realistically they're not going to have much impact in the short run. In a similar vein, I guess, is your comments on necessity as a potential issue. I mean, in public international law, necessity is a very stringent doctrine, which is really, you're talking about almost existential threat to countries. I mean, it has to be a grave and imminent peril that justifies necessity as a doctrine. And it's a public international law doctrine, not a domestic law doctrine. And that obviously complicates its use. I mean, it suggests, I suppose, Iraq, even though they didn't use it as a necessity issue, with the Security Council resolution, might be one of the ways to link debt and necessity. But that's obviously politically a very difficult issue to do. I was delighted and intrigued to see you mentioning sukuk bonds as an approach, because the idea of having bonds where there's risk sharing is obviously very attractive, and at least as first impression. My understanding is one of the problems with sukuk bonds is that they're very conservative, precisely because of the risk sharing element, that they often don't get used for more innovative projects because the investors are not all that attracted to sharing high risk operations. But I think it's something that's worth exploring. Two things. One is when you talked about IFI equity holders and using them in some way. What I was wondering is that referring to the callable capital in the MDBs and suggesting that somehow or another that could be used as a risk sharing or as some sort of protection, which is an intriguing idea. I don't know how realistic that is in practice, politically at least. And final point on I was thinking as you were talking is one of the things that your paper drives home is that at the end of the day, the real discipline in finance is not so much what's in the contract, but the question of access to more financing. And one of the problems with the DSSI is it's not offering countries enough to give up the potential of getting money from the bond markets or from other lenders in the future, because of, they're really worried about the access to new financing, even though potentially legally then contractually they would have a right to do that. So that's just an interesting point on that. On Amitabh's paper, which raises lots of issues, the one that I was hoping you would discuss, which you didn't discuss now, but is in the paper, is the Indian resurgent bonds, because the idea of diaspora bonds of various sorts raises some really interesting issues particularly for Africa, because there's obviously a large African diaspora that could potentially contribute in some way. There's a large, and that diaspora is not just, as in the case of India, people who come from the countries, but who were taken away long ago. And so it raises a number of interesting political issues as well as financial issues. So hopefully in the paper you'll develop that a little bit more, because I think it's interesting.
It's actually just been suggested for the Philippines and for Vietnam and other countries which like diaspora abroad. So I will develop that more. Okay.
Great. I see that while I was talking, a lot of questions came in, or a lot of comments. If there's someone, a lot of this was the discussion too with Zongwe about the issues that he had raised, and so I think I'll leave it to him to do that. If there's anyone who wants to add a comment, either from one of the presenters or from the audience, this is a good chance to do that. I know it's been a long session, and for some people, I know it's some people, I guess, it's getting to lunchtime, and for some people, it's getting to sleeping time. So I think what we'll do is close. And just in closing, I just want to thank firstly all our presenters and our commentators. It's been a really rich and interesting session, and so thank you everyone for coming at very different times. For both you and for the audience, I hope you'll join us tomorrow at the same time for a different set of papers and commentators. As you know, this is the first of 4 workshops for this book project on sovereign debt management and renegotiation in the SADC region. It's not often that there's a project that focuses on a particular region. And so I hope this allows us to make some really interesting comments and observations about what happens in this region. And just the final comment, thank you, is I want to thank the Open Society Initiative for Southern Africa, which is part of the Open Society network, for funding this. I should say we're the beneficiaries of COVID, and every cloud has a silver lining, I guess. The money for this was, we had another project that we were not able to complete because of COVID, and OSISA very generously said, don't you have another use for the money? And they agreed that this was a good use of the money. And I think the papers today and the comments today show that their instinct was good, and that this is really the beginning of an interesting project. So thank you, everyone. I hope to see you all tomorrow. We will also, as we said, we'll circulate some written comments to all of the authors separately. But thank you, and have a good day, evening. But I declare this meeting closed now. So thanks, everyone. Bye.